go ahead and begin. Good afternoon, Checkmate Trading Crew. Today it is July 6th, 2022, Wednesday. We're set today to get some FOMC minutes. So we'll see what happens to the markets. For the past few meetings, whenever the minutes have come out, we have seen a little bit of volatility in the markets, either to the upside or downside, or sometimes both. So we will see. Just like every other FOMC, just remember, guys, most of the world is asleep. Okay, they're closed. Europe's closed. Asia is already halfway to bed, and so sometimes it's possible that you get moves overnight or the next day after any type of FOMC event, because generally it's around 2 o'clock in Eastern time. So, again, rest of the world is asleep. So if you're going to do any big trades, which I don't recommend in this environment, I don't recommend you do anything big unless you're legging in slowly for like a long-term move or something. This is not the environment to have bigger trades all at once. But if you are tempted to do so, I highly recommend that you guys wait at least till tomorrow or the day after even. But that's just me, all right? Let's get down to business. I want to go over our positions, first of all, because there were some changes that I made yesterday. As you guys know from Discord, I always post my trades. I did add in yesterday to my FXI put spreads, which are doing well right now. They have a decent profit. The August naked puts that I bought, they're still underwater, but the spreads, the November put spreads, they're actually doing pretty good. So spreads for the win. I should have started with spreads, but I didn't. So it is what it is. Most of my FXI positioning is in those November spreads. Before I get on actually any further, let's talk about gold for a second. I got stopped out of this yesterday. I told everybody that if we close under this, what is this, 1783.4, that I'll get out. And that's what I did. We ended up closing there late in the afternoon. We started to look like it was rallying, but then it was coming back. And when it was around here, around 1770 or so, about an hour before markets closed, I just got out because I knew it wasn't going to come back. So I just got out around there. I think after legging in my average price on those December spreads, just so you guys know, as you can see, it's empty now because I sold out. I don't have any positions anymore, so I'm out. But anyway, I legged in the 180, 200 call spreads for December. My average price was around 3. I got out around, I think on average it was like 255 or 260, something like that. So what is that? Like a 15-20% loss on it? It is what it is. It was a very small position. About 1% of my portfolio was in it at the time. So 20% loss, I lost about 0.2%, 0.15 to 0.2% of my portfolio with that. It is what it is. That's why I was keeping everything small. I diverted that money though, whatever I sold, I did divert that into more FXI put spreads and EEM puts, the 39s. I got some more yesterday too. So more of these and more FXI puts. So I'm going to concentrate more on that. It's working out very well today. Today, everything is in profit. So overall, my China position is in profit. Overall, my EEM positions are now in profit as well. Okay. I am still about 94, 95% in cash. Okay. I will be legging more. I'm also waiting for those FOMC minutes. So we will see. Okay. We shall see what happens. Hopefully, I don't know, maybe if we see a little bit of a relief rally from there, maybe I might add a little bit more. I can't predict the future. Nobody can. So let's see what happens. Okay. As far as the other markets, as I said, why am I so bearish on China? We've had some new members come in, and I get it. Some of you may not have been watching the older videos, but I said that wherever Australian dollar goes, China follows. Okay, the Australian dollar is a lie detector test for China. Okay, whenever this goes down, generally it means that China is not doing well. And the reason why is because when China is doing well, when their production is up, they need a lot of raw materials, and they import a lot of these raw materials from Australia. Your metals, copper, different minerals, they get it from Australia. And so whenever they're buying large amounts of these metals, there is a bid for the Australian dollar to conduct that trade. All right, so if we don't see this, remember right here, this is when China announced that they were going to loosen COVID restrictions. So we had a 2-day pump, but then I have these pivots. All right, this green line is a pivot. It's a pivot that's worked all the way since the 80s. Okay, and we broke out of it. All right, but then it broke back down into it. So it was like a false breakout. Okay, when we have a false breakout, usually the down move can be very quick. All right, for currencies, this is quite quick. This is a pretty big move for a very short amount of time for a currency. All right, I know for stocks it may not seem as much, but for a currency, this is huge. Okay, currency markets are way bigger than stocks. Okay, so it's a lot easier to turn around a tugboat than it is the Titanic. Okay, so just keep that in mind. So this is going down. At first, you may be thinking, well, what about, is it the dollar? And that is front and center right now, is the dollar. Okay, most traders, I don't care what you're trading, cryptos, equities, bonds, Forex, whatever it is, whatever you're trading, if you're not looking at the dollar, you're behind. Okay, everybody's looking at this right now. All right. A lot of you may be thinking, well, maybe it's because of this dollar rampage that we're seeing Australian dollar come down. It could be. It could be. Most of this weakness, this initial rally, most of this came from the weakness in the euro. And then now it's spread. It's spreading to other currencies. All right. And we're going to talk about this more. We're going to talk about this more when it comes to emerging markets. But yes, right now, the dollar is just on a rampage up. And it's affecting, it's affecting a lot of things here. Like TNX, interest rates are going up. It's a flight to safety. So people are buying bonds now. All right. So people are buying bonds. There is a flight to safety, a dash for cash, so to speak. And so that is a risk off sentiment. All right. Let's just see. Actually, I'm curious myself. Oh no, what I showed you, I'm sorry. I showed you, I thought this was bonds. This is actually TNX. This is the 10-year treasury. So no, that people are selling off their bonds, okay? People are selling off their treasuries, causing rates to go up. Actually, I haven't checked this today yet. We might as well check it. Let's see what's going on. TIP, TLT. So this is why. Okay. So it broke back into that range. So we were breaking out of that range in TIP, TLT, and then now TLT, our TIP, TLT ratio is actually coming back into that range. So people are selling off their bonds, maybe because of this inflation signal. I mean, this is one day, it's not a trend, but with all these quantitative algorithms, whenever they see something like this, they may sell off some of their long-term bonds. So, okay, so I see that this trade is coming back. It's within the range again. Will it come back and will it do this? That's what I originally thought. I originally thought that the TIP-TLT ratio would go like this, at least until next year. So it broke down a little bit, but now it's coming back inside that box. If it closes above this 99 to a 1 area, if it closes above this, we may see the inflationary trade come back. So we'll see. So again, TNX is up, so bonds are down. So no, it's not a risk-off sentiment yet. More like perhaps maybe inflation is coming back. Let's actually take a look at some of our commodities, okay? Oil just breaking down. We call the top here. Too bad. I actually am lowering where I might scale into some oil put debit spreads. I'm actually lowering it to around 111. I said I may consider doing it like around 115, 114 or so. I've lowered that to 111. My big put orders are going to come in at 119, 120 still. I'm still not budging from that. The big one, the big trade. Okay, I may leg in a little bit at 111 though. Okay, so if it comes back up around here, I'm going to start legging into some puts. Very small. Main orders are going to come here. So I did revise my trading plan for oil a little bit because I don't think I think coming back, it's a very low chance it's going to come back here until next year. Maybe next like February, March. Maybe it might start coming back up again to these levels. But until then, I don't think so. I don't think it's going to happen. Same thing with corn. We call the top in grains a week or two ago. It was around here. We called the top in grains. He said, this is the top. All right. Too bad we didn't do anything about it, though. Yeah, it's not giving. It didn't even retrace. It didn't even retrace a little bit. I mean, there was this one day. That's hardly a retrace. That's nothing. I thought it would at least come back around here, 720 or so. But it didn't. It never did. It just kept going down, down, down. I know some of you were long corn from like here. Hopefully, I hope you guys took my warning and got out. So as long as you avoided these losses, I think that's a win. In today's market, if you're avoiding losses, that's a win. Will this come back? Probably not till next year. I don't think this is going to come back until next planting season. Maybe, if that. Okay. Same thing with gold. I think gold, I was a bit too early, a little bit too ambitious. I kept everything small. I wasn't too ambitious, but I think that seasonally or just cycle-wise, maybe we need to wait. I think we need to wait till maybe around March or so. Again, March. I think commodities will probably come back next year. Maybe March, maybe April, something like that. We'll see. But yeah, I think we're too soon. This may even go down further. It may go down into like the 1500s or so. We'll see. Especially with the dollar going up, I can see it going into the 1500s. Let's look at copper. Copper, it appeared as if it wanted to bottom out. We will see. If copper can close around this level, that would definitely be a bottom signal. But seeing as it's, it was a little bit higher this morning, seeing as it's losing some ground, maybe not. Maybe there's still some more pain ahead for copper. But we will see. All right. Speaking of the metals, let's just to backtrack here. This is originally the reason why I was so that I started my gold long position. Generally, when this ratio, the gold to copper ratio, when it starts going up, as you can see, whenever it has had big run-ups, gold has usually followed. Usually, gold follows this ratio. Didn't happen this time, though. It didn't happen this time. So it is what it is. This still is going up. I mean, technically, this ratio could go up even if gold goes down. It just means copper is falling down even faster, right? If this ratio is going up but gold is coming down, it means copper is dropping that much faster than gold, all right? This is an overall risk-off signal for the broad market. Okay, whenever store of value metals, precious metals, outperform copper. All right. So as long as this is trending up, I still think that we're going to have an environment where we sell the rips in the market. Okay. So this is just one signal. There's a lot of signals, and all the signals are still pointed toward a more risk-off sentiment. But this is just one of them. This is the reason why I went long on gold to begin with. Again, I got stopped out. I took a very, very small loss of a very small position, and I'm just in wait and see mode now in the metals. Okay. So that's the metals. What else? Let's take a look at these bond spreads. This is the 10-year, 30-year, and 10-year. It is just kind of flat, just hanging out here. Bank profitability. Let's take a look at the 10 and 2. Ooh. Oh, it started off inverted. What's going on with bank stocks? Now, keep in mind, guys, we're about to have earnings season here in the U.S. in about a week and a half. I believe JP Morgan always kicks off our earnings seasons. JP Morgan is one of our largest banks here in the United States. They usually lead the earnings season here. And, for the last few earnings, we have seen about 70 to 80% of the time, bank stocks tend to do well in about a week to a week and a half before JP Morgan's earnings release. I don't know if that's going to happen this time around, but what you would want to see if you're going to take that trade, if I'm not going to take that trade, but if you're going to take that trade, I definitely recommend that you wait to see this come up a little bit. So generally when this touches negative, it's bad. But when it touches negative and then bounces back up quickly, like here, bank stocks can do very well in something like this. Okay, but you need to see this first before it happens. Just because you see this one little green candle doesn't mean that this is going to happen. Okay, so if I were you, I would wait for confirmation of something like this, and then you can try to do a bank pre-ER play on the call side. I won't be taking that trade. Again, it's if you're going to do a trade like that, it's going to have to be small. And right now, those short-term small trades, I'm not really that interested in those, just because in this market, those positions can fail very quickly. So I would rather wait for the big high probability moves and wait for that. But to each their own. If you like to play those short-term plays, and I know bank ERs are very popular to play, again, seasonally, about a week and a half before JP Morgan reports earnings, bank stocks tend to do well. Bank stocks also tend to do well after yields, the 10 and 2 inverts, and then strongly responds in the other direction. Okay? So if you can see that happening, maybe it's a worthwhile play for you. Again, I'm not going to be doing it, but that is something. If I were inclined to do so, I'd be waiting for this to happen first. Okay? So that's bonds. TIP, TLT, we already saw this. Oh, it's coming back up more. Look at that. We shall see. All right, maybe it does do that, what I thought. I do know that the Fed watches this, okay? The Fed does watch this. When you read the Fed minutes, they will refer to this ratio, the TIP-TLT ratio, as the benchmark versus indexed, okay? Benchmark versus indexed. That's what they call this in Fed talk. All right, so this is just the Treasury, the inflation protected Treasury ETF divided by the long-term Treasury bond ETF. All right, so again, benchmark versus indexed. If you see that in the FOMC minutes, this is what they're talking about. Okay, they do look at this. I suspect though that if this does continue its breakdown, and continues coming down, that perhaps the Fed may ease on tightening. Okay. This is also a reason why I was so confident in calling the tops in oil and grains. So the bond market kind of front ran that. Always, the bond market and currency markets tend to show us where the rest of the market is going to go. And again, these are the smartest guys in every trading floor. It's these guys that play around with bonds and currencies. All right. I don't know if this is going to go up like this or if it's going to keep breaking down. But if it keeps breaking down, I suspect the Fed will probably start talking about, they'll continue talking about easing that tightening. But we will see. Okay. We do have FOMC minutes later today. Maybe this is just in anticipation of that. We do have FOMC meeting, another big meeting for July, for that last week of July. So anything can happen between now and then. All right. So just keep an open mind. You never know. All right. So what else? Oh, today I also said that I was going to go over EEM as well. Our EEM trade is doing well now. Here is, I put an overlay. This is CEW. CEW. What is CEW? CEW is an emerging market currency ETF. All right. It's an emerging market currency ETF. Generally, what I see is that whenever we have a change in the direction of EEM, we generally have a change in direction in CEW first. Okay. If you notice, for example, here, back in 2014, the top in the market, the CEW called it a few weeks earlier. Actually, a couple months earlier. But really, it's this right here that really called it. We saw a divergence coming here from July to when actually it happened in September. So sometimes CEW will front run EEM by 2 weeks, 2 to 6 weeks sometimes. Okay, so it's not like you see something in CEW and boom, next day you're gonna move. No. It doesn't work like that. These trends take a lot longer, and the front run is a bit longer on this. Okay, anywhere from 2 to 6 weeks. So patience is key. Patience. All right. So generally that's what we see here. We see that this CEW front runs. As you can see here, the big drop in CEW happened in April in 2018, but then it wasn't until around the beginning of June where we saw the big drop in EEM. Same thing here. CEW bottomed out in 2018 around October or so, but for EEM it took them until end of October, early November to see a bottoming. So it just front runs it just by a few weeks. All right. Right now, CEW is around its COVID lows. Okay. It's around the COVID lows. I'm not saying that's where EEM is going to go, but it's pretty compelling. I don't know about COVID lows. 33, definitely possible. COVID lows down to 29. Oof. I mean, wow. Our put payout, I mean, that's going to be amazing. Our EEM puts will I don't know. I think I'll probably, if the volatility, also the implied volatility goes up, and as we get closer and closer, it'll probably get steeper. The skew will get steeper. So I'm guessing if it goes down to COVID lows again, we'll probably be up like 300, 400% on those puts easily. And not a lot of active management too. You don't see me getting in and out of that. It's just a buy and hold. It's long dated. It's very simple to manage. That's the type of trades I like. Easy money. Okay, if this drops. We'll see if it drops. We'll see. Okay. Risk is managed. It's still a relatively small position. I was hoping to build more of it. Luckily, I was able to get some more yesterday, but we'll see. I don't know. Maybe after FOMC minutes, maybe it pops up just a little bit. If it pops up just a little bit, and then CEW doesn't make it doesn't make a very good upward motion as well, and let's say it just continues down, then I'm loading up on more puts on EEM for March. Same ones, 39s. I'm going to load up more. We'll see. We will see. So this is another indicator right here, CEW, okay? As you can see, I love to get, I not only do I use options, a lot of people say, well, Mickey, you never use charts. Yeah, I do. I do use charts, okay? But this is how I use charts. I like to use currency markets, bond markets. I like to see certain ratios. Those are the type of charting techniques and technical analysis that I look at. So I do use charts from time to time. It's not like I don't restrict myself in any type of strategies or any type of indicators. I don't limit myself, but I try to use the ones that give us the clearest signals. All right. And CEW gives very clear signals. Very, very high accuracy, like 80-90% accuracy. Yeah, there's that 10-20%. So again, I always say this. First, second, and third most important things, risk management. Okay? First, second, and third things, risk management, protection of capital. That's the most important thing. As traders, you are paid to manage risk. Your number one priority is to protect your capital at all times. All right. So no matter how accurate something is, you have to manage risk. All right. I always say that. So that's always worth repeating. But yes, this is what I'm looking at. I want to see this come down some more. All right. So that is where this comes from. All right. Also, too, I've been looking at different emerging market bonds, sovereign wealth bonds. Let me tell you this, the junk bonds in emerging markets, I mean, it's not even worth looking at because literally it's just free falling. So it's just getting sold off indiscriminately. So it's really hard to get a signal from that. It just looks really, really bad. But even right now, sovereign wealth emerging market bonds are not having a good time. Most bonds, this one is the one that I find that tracks most closely in local currency. You'll probably see, there's a much bigger ETF that does emerging market bonds. JP Morgan makes an index. They make this emerging market bond index, and a lot of different companies try to replicate that index with their own ETF. You're going to see some ETFs that are US dollar denominated, where it takes out that currency risk. I like to look at things just local currency. It does look a lot better, though, in dollars, just because dollars have had such strength. But that strength in the dollar usually is not good for EEM. So I am just looking at it from the local currency perspective. But anyway, as you can see already, those sovereign wealth bonds are lower. A collection of them are lower than the COVID lows. All right. Now, this does pay a dividend as well, too. So, there's a drift because of that dividend. But still, I think even accounting for that, I still think this is quite weak. I mean, it's showing very similar signals to the currency signal. So I think equities are going to follow. Maybe not soon, but maybe in a couple weeks. And again, that's why I kept those long dated for March, because it could be a while. It could be a couple weeks for this to play out. All right. So patience. Okay. Every rally, I'm going to leg more in. I should have legged more in yesterday, but I mean, it is what it is. There's no crystal ball to this. Hindsight's 20/20. We always have to manage risk. Okay. So I do believe, though, in the end, I don't know what path it's going to take, but I do believe that we are going to see some lower prints in EEM. I'm thinking 33, but I mean, based on what CEW and these sovereign wealth emerging market bond funds are doing, I mean, we might see COVID lows, which would be like 29.30. Oh, what a payday that would be. All right. That would be crazy. Okay. That would probably also bring down China with it. So our China FXI puts will probably print too. So that's good. We will see. Going back to US based bonds, this is, I already posted this on our Discord. This is our S&P 500 orange line versus the advanced decline in US junk bonds. As you can see, we've had another decline yesterday. So again, unless we see some divergence where this advanced decline line is going up, and in order for it to have a good upward move, we need to see 4 or 5 days in a row of advances over declines. Okay, we need to see a higher high in this before we can say, okay, this is the bottom. All right, we're not going to get a sustained rally if this line doesn't go up. Okay, so as you can see here, I mean, you can see this on the 1 month. No, this is the 3 month. So every rally, if this doesn't follow, it gets sold back down. Every rally, it gets sold back down. Here, it was curling up. Oh, nope, this is curling down, going back down. All right, so this has been very accurate, a little bit more timely. It also called the top in the market back in end of 2021. It was already diverging from the market, and the market was making new all-time highs, but advanced decline was saying that's BS, and the market followed. In the end, if there's a disagreement between the bond market and the currency markets versus equity markets, bond and currencies win. Bond and currencies is like the big brother, little brother. Okay, when big brother tells little brother move, little bro comes with him. Okay, it's just the way it is. All right. Okay, so that is equities positions in a nutshell. Let's just go over positions real quick. Again, one more time. Again, gold, I got stopped out, small loss. It was about 1% of my position, lost about 15-20%. So overall in my spec account, I'm down 0.15 or 0.2%. I diverted some of that back into some more EEM puts yesterday. So those are doing well. And also FXI put spreads. I still have them. I still have them for November. I added more of this. I still have my original August. This is really small. I mean, all of it is pretty small. Again, I'm 94-95% in cash still. But most of my FXI puts are now in this, in these spreads rather than just the naked puts. I have extremely small amount here. Most of it is here, all right? I still have my UVXY call spreads for December still in the profit, about 15-20%. It just won't move that much. It's just been around there for the past couple of weeks. I still have about 5-6 months left in these. I think that's all my positions so far. Oh no, I still have that very small amount in uranium, those lottery tickets that only got 2 contracts filled. I only got 2 contracts filled. So I mean, that's like whatever. That's like minuscule, almost nothing pretty much from my portfolio. That's pretty much almost nothing. So I still have that. But going back to UVXY, VVIX is still super low. I mean, the premiums on UVXY, any UVXY options or VIX options is really cheap. So if one were to play a quote unquote rally in the market, I recommend, or at least you should consider. I don't recommend anything, guys. I backtrack there. None of this is financial, recommendations. Okay, I'm just telling you what my plan is and what my thoughts are. But if VVIX stays this low, and if one were compelled to get long on the U.S. equity markets, UVXY puts are a cheap way of playing that right now. because VVIX is just so damn low. UVXY premium is really cheap right now. Okay, that's why originally I had even set up the UVXY call spreads. It's just because the VVIX being that low, it just gives you such an edge. Okay, it is such an edge. Oops. Yeah, it's such an edge to have when it's that cheap. So if we drift around here for a bit for the next couple of weeks, or if this drops a little bit to 13s, I may even leg into a little bit more of this. Okay, I may even leg a little bit more. I'm actually now looking at the 1525s, just because the skew, it was actually a bit steeper a month ago, which it doesn't make a lot of sense. It's not very intuitive why it would flatten now as we get closer to it, but it's still pretty far. So, I mean, things can happen, and options move with supply and demand dynamics. So, apparently maybe there's not much speculation on the call side anymore for UVXY, but as far as this, because of the skew flattening, I will want to widen that. Maybe $10 wide spread, long the 15, short the 25. We're able to take advantage of a bigger skew. Right now, the skew is just not that steep. It's about 5 percentage point steepness. It was around 8, 9, almost 10% steepness when I first got in, between the 10 and 20. Now, to get that 10% steepness or so, we're gonna have to go out a little bit more. To $10 wide strikes, which I'm willing to do. It's still very, very good payout ratio. It's like $1.80 right now to get a $10 payout. That's not bad. That's better than 4-to-1 reward to risk. I'm game for that. That sounds good. So again, if we see this coming down a little bit, I might leg in some more of this. All right. I still think we have one more wave of volatility left in this market, at least one more before the year is out. Okay, that's what I'm preparing for. But we will leg in slowly. I will be patient with this. I will be patient. Okay, so I just wanted to run down my positions for that. I see we have some questions here. In simple terms, does a blue line need to cross the orange one? Oh, are you talking about the AD line, the advanced decline line? No, it does not. It does not. It does not have to cross at all. They are independent. Look at this is the scale for the advanced decline line. This is the S&P 500 scale. As you can see, the scales are not even the same, right? I just did this so that you can see the trend. It's trending down, so the market is trending down. I didn't do this because like it has to cross over the other, and I get it. Like a lot of people who are trading, and especially if they learn via the charting methods, quote unquote technical analysis, they always look for these lines crossing. If my orange crayon line goes above the blue crayon line, all of a sudden it's a golden cross. But then if it's the other way around, they call it a death cross, and they put all these like fancy names, and the media likes to hype these things up. I don't buy into any of that. Yeah. It does, but it doesn't necessarily mean that it has to cross. Okay, it just looks like it's crossing because I've scaled it so that they overlap with each other. That's all it is. It just happens to overlap and cross at certain times. But it's not about the cross that's important. It's about the trend. If this is trending down, it means the market's overall trend is down. Basically, when you see this advanced decline coming down, this blue line coming down, it means junk bonds. It means there's money leaving the system. There's no appetite for speculation. Whenever you see the appetite for speculation coming back, you will see it in the junk part of the bond market, okay? Usually that's where you see liquidity coming back into the market first. All of these people who are in like treasuries, they'll start venturing into junk bonds. And then once junk bonds come up, then all that money will spill over into the equity markets. So generally speculation starts with junk bonds first, and then it spills over Exactly. That's what I'm looking for. I am looking for a trend in junk bonds to see that reversal coming. So again, that's why I keep saying, in order to see this trend move up and make a higher high, you're going to need to see 4 or 5 days in a row of advances over declines in the junk bond market. And when you see that, that is when we're going to say, okay, the bottom is close. Okay, but until we see that, as you can see, market was going up. This was that bear market rally. We were kind of like going in, and it looked like it was about to curve up. Nope, but this was curving down. Boom. Again, bond market, currency market is the bigger bro. Equity markets is the little bro. Wherever big bro goes, little bro follows. All right. Yeah. Okay. So yeah. So that is that's the theory behind this, at least. Okay. I'm going to be tracking this every day. I post this every day on a Discord. This is what really is going to help us out with timing that bottom. Even if you're trading cryptos only, this definitely helps, because cryptos is basically a product of liquidity. All right, you need excess liquidity in order for very speculative parts of the market like crypto to get a bid. All right, so even for crypto, I suggest, I would think, and crypto is a relatively new market. Yes, it's been around for a decade, but I mean, bonds have been around for centuries. Stocks have been around for centuries. Okay, so relatively speaking, crypto is it's a baby market in the most earliest days of its infancy still. But I would suspect that cryptos are going to be susceptible to this liquidity. Okay, this means liquidity is tightening, less money in the system. As money enters, speculative parts of the market are going to see that bounce. So even as crypto traders, I would monitor this line. And so, will when this curves up after we get that signal, is it possible that risk assets have already come up 5 to 10% from the bottom? Yeah, definitely. Okay. So to think that you're going to get the exact bottom, I think is foolish. That's a fool's game. Okay. No one can time the exact bottom, but if this is the bottom, then risk assets like stocks, cryptos, they're probably going to go up 20, 30% when this is all over. All right. So what if you miss out on the first 5 or 10? There's still a lot of meat on that bone. All right. Risk management. Get that clear signal before you jump in. All right. I'd rather show up to a party 5 or 10 minutes late than show up to a party that may not even start. You see what I'm saying? So, it's always good to get that validation with this, because, there are false moves in the market. Look, bear market rallies do happen. And most people get wiped out in a bear market rally. Actually, speaking of bear market rallies, somebody put on our Discord, MSC, I think this was you, there was a South Korean hedge fund, AI hedge fund, Uprise, that got wiped out. They lost 99% of their clients' money betting against Luna during its crash. So if you don't know anything about Luna was this protocol, and it crashed. 99% of its value, almost 100% of its value just went out the door in a matter of days. Okay. Even though they were right on the direction, they were right. They shorted it while it was crashing, but they still lost 99% of their money. Why is that? Because of bear market rallies. When these things fall, sometimes there's violent counter reactions. Okay, so a few of those violent counter reactions is what caused this fund to go bust. All right, and I keep saying this, and I've been saying this for a few months now. It's very common to have bears get wiped out in a bear market. Why is that? Why do bears get wiped out in a bear market? Because bear market rallies are ferocious. All right. In low liquidity markets, bear markets are usually caused by low liquidity in risk assets. All right. So when there's lower liquidity, prices crash downward. It's very different from certain commodities. Certain commodities like oil and grains, they actually crash upwards when there's low liquidity. So it's different for every market, but for risk assets, okay? Risk assets like stocks, crypto, whenever there's low liquidity, prices come down because there's no more bids anymore, all right? In those low liquidity markets, when sellers get exhausted, you have these huge reactions to the other side, and that is what wipes out most bears, okay? So that kind of ties in with what's going on in the world. So just wanted to make that connection. But yes, bear market rallies do happen. So how do you know if that's really the next bull market, or if that's just a bear market rally? Well, that's our sign right here. It's our corporate bond advanced decline line, all right? Again, it's just one data point we look at. It's a pretty compelling one. It's a pretty strong one and a pretty accurate one, but it's just one data point. So always keep that in mind. You still need to manage risk, all right? Always manage risk. All right, so that is that. Oh, now let's talk about Bitcoin, okay? I wanted to show you guys something in Bitcoin. First off, this is something that I've been playing around with for a few months now. I've been toying around with this idea. Apparently, though, I'm not the only one thinking about this. Apparently, there's a lot of different hedge funds that actually look at this as well. It's the Bitcoin to gold ratio, all right? The dollar, all right? Let me just say it again. The dollar is like the most important thing right now, okay? Like, if you're trading anything, commodities, other currencies, equities, no matter what equity, no matter in what country, cryptos, whatever, you got to be looking at the dollar. Now, the dollar has had this rampage move, and sometimes you want to take that dollar noise out of your chart. And that's what this does, okay? It replaces, Bitcoin. When you price anything in dollars, it's always, the ratio is always Bitcoin or whatever your asset is divided by the value of the dollar. The value of the dollar for those of us here in the United States is always going to be $1. $1 equals $1, right? But, sometimes though, when that dollar is moving a lot, it can definitely affect how things get priced. If you actually look at the price of the S&P 500 in euros, it actually looks like it's breaking out already. Okay. Actually, let me show you guys. Okay. Instead of just talking about it, let's actually. Where are you? Sure. Let's use that one. Okay. It actually kind of looks like it's already trying to break out if you price S&P 500 to euros. All right. I mean, still the trend is down, but this chart looks a lot stronger than just SPX priced in dollars. Okay. This looks really weak, but if you price it in euros, no, and a third of the world actually trades, a third of the index S&P 500 trading is actually done in euro denominations, about a third. All right. In the Middle East, a lot of Middle Eastern investors invest in the United States, and they look at things denominated in euros. So that's, anyway, that's to get rid of that dollar noise. I divided Bitcoin by gold, and I think that is what a lot of hedge funds are looking at, and I think that's where we might even bottom. Okay, that's around 6.3. Okay, so here's the theory now. All right, so it depends on where gold is going to go, as this ratio, the denominator is in gold. So let's say gold comes down to 1,500. Okay, this is what, let's say 6.2. Okay. If gold goes down to 1,500, that means right here we'll be at 9,300 in Bitcoin, $9,300 in Bitcoin. Okay. So if gold goes down to 1,500, we might see the bottom happening around 9,300, according to this chart. Okay. If you believe in this chart. Okay. Now this chart, this line, this trend goes back till 2016, 2017. It's a pretty strong chart. You know, when we see Bitcoin, every Bitcoin winter or every crypto winter, it has touched that line and bounced back. All right. I suspect that it will do the same. It'll touch and come back. Now, if gold rallies, all right, let's say this goes sideways and gold has another cycle and goes up to 2,000 or so, that means that we're going to be probably going up around here, around more 7. So if that's the case, if it takes a lot longer for Bitcoin to bottom out and gold is at 2,000, let's say, then we can expect the bottom in Bitcoin to be about 14,000. All right. So it's a, yeah, so it will keep changing based on where gold is at. But I suspect gold is going to fall to 1,500. And if that's the case, and if Bitcoin is to bottom sooner than later, and gold goes to 1,500, that means we can expect around $9,500 to about $10,000 for a Bitcoin if it bottoms out around here. All right. Something to think about. So it's just a chart to have up, and when you see it approach that line, that may be a good place to start buying long term for Bitcoin if you are a long term bull for Bitcoin. I myself will start buying here for a long term hold, non-leveraged. I don't do that whole, leveraged perpetual futures. No, I don't do all that. I will just buy physical spot Bitcoin and hold it if we get to around here. That's where I'll start buying. Okay. So I think this is worth looking at. Again, it's a trend line that's been working since 2016, 2017. So it's a pretty strong trend line. All right. I'm okay with some risk right here. I'm prepared to take that risk right here. All right. If we close for 2 or 3 weeks under that line, that's my stop. Okay. So here it did close like 1 week, but then after a week, it popped back in right here. All right. So again, 3 weeks. If it closes below this for 2 or 3 weeks, that's my stop and I get out. All right. Buy here at the line, stop out after 2 or 3 weekly closes beneath the line. That's my plan for Bitcoin. All right. So hope that's helpful. Let's look at Bitcoin positioning. Okay, so something that I wanted to share with you guys for Bitcoin is that we've been seeing a lot of call buying. Yes, I know, call buying in Bitcoin. Okay, so animal spirits are coming back. Is this temporary? I think so. And we see periods of this. We saw this in end of 2017. We saw this right before this market crash in November, December, where call chasing happened. Look at that. Calls bought. 50% of block trades today was calls that were being bought. Okay. So even institutions are getting involved. Now it looks like a lot of that is in this strike. Well, when I checked this morning, this was the number one volume. This 29th of July, 25,000 calls. Actually, the end of month, July, if memory serves me correct here, a few weeks ago, I saw huge institutional block trades of calls sold at strikes 24,000 and above for July. And then for September and December, I saw 38,000 and above strikes getting sold. So this could be just some short covering on those covered calls, meaning they sold these covered calls a few weeks ago and now they're buying it back now that it's cheaper. Okay, so they made a little bit of income on selling those calls. And I think a lot of that is buying to cover those short calls. But I think these July 8ths that are closer to in the money like this, I think that's speculation. There's some short-term speculation that's coming back into the market, I think. All right. If you look at, historical volatility is falling down. And so as actual price movement becomes a little bit more stable, institutions are more willing to come back in and speculate. So that is one thing that I notice, that we've been seeing a lot of call buying. Let's just take a look at, I want to take a look at the actual options positioning. DVOL is still staying around this 80s zone, okay? This 80s zone. If you look at positioning here, let's just take a look also at the data. I just want to take a look at the skew first. Yeah, pretty much it's puts. August. Oh, we got an August now. We didn't have an August expiration. I guess this just opened as we're getting closer to mid-July. So that looks like an even smile so far. So both sides seeing some speculation. And see, we're starting to see steepening on that forward skew. All right. Although most of that volume is still in the shorter dated contracts, I do think there's probably some bids coming for later this year. Maybe some more. Yeah, of course. No. Yeah. Usually institutions are thinking 6 months to a year out. So even in like S&P 500, like SPY, SPX, you will actually see large block orders. Like sometimes, you see like all these volumes in like the shorter dated strikes, but then you see like this one off like strike that's 6 months away that has a lot of volume on these random days. Yeah, those are institutions. Big institutions always hedge and plan 6 months to a year ahead of time. So yeah, I definitely agree with that sentiment that, most of these longer dated ones are going to be like your institutions, your big institutions. Most likely it's like your big institutions who are holding some Bitcoin, okay, as a small percentage of their portfolio or something, and they're hedging that risk. They're probably buying some puts. If they're buying calls, it might be just smaller positions just to supplement what they're holding. It's possible. They might be doing some type of risk reversal trade where they're selling some maybe puts to take advantage of the high skew and then buying some calls with it. That's very possible too. We saw a lot of out the money puts getting sold about a couple of weeks ago. So and that's when this skew was still there. So I wouldn't be surprised if they did something called a risk reversal trade. And a risk reversal trade is where you sell puts and buy calls using some of that premium. So I wouldn't doubt if that's what they did, was sell puts here and buy some calls here for a risk reversal trade. Wouldn't doubt that for a second. That's a very institutional play. So yeah, again, my thesis is institutions are taking over Bitcoin. They took over S&P 500. I think they're going to take over Bitcoin. It's already starting. It already started, in my opinion. Okay, I think the evidence is quite clear. All right, traditional finance is not the enemy here. You need traditional finance to participate in these markets, to have these markets mature. And I think Bitcoin is definitely getting that institutional participation. All right. That doesn't mean all of crypto is getting institutional participation, okay? It doesn't mean that these quote unquote, pardon my language, shit coins are, it doesn't mean that they're getting involved in that. So if you're betting on these shit coins, you're still gambling, in my opinion, okay? But Bitcoin, definitely we're seeing some money flow in and some participation. So we'll see what happens in the long term. But again, right. 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 So yeah, that too. That's a very good point too. what MSC is mentioning as the regulatory environment for cryptos. I actually think that the fact that they're talking about Bitcoin is actually very positive. Usually investors want to see some type of investor protection laws before they put money into it. There is a reason why the U.S. stock market is most favored. If you look at the size and revenue of a company in the same industry, and one's listed in the United States and does business in the United States, and one is listed in like a foreign market, always for the same size company in revenue and in industry, your U.S. company is always valued higher. Why is that? Well, it's because in the United States, we have better minority shareholder protection laws. Okay. And so it gives more peace of mind. There's recourse for a minority shareholder if they feel like they've been wronged by management or by a majority shareholder. So there are investor protection laws that are very strong here in the United States, and that's why the world wants to put their money in the United States. All right. So yes, I do agree with that. I think that them talking about regulating Bitcoins more, I think in the long term is very, very bullish for Bitcoin, as then I can see a lot more institutional investors feeling comfortable entering that market, 100%. Now, as far as options positioning is concerned, let's just take a look and see what's going on. July 8th, this was the high volume. I forgot. Every time I come to this side, I have to redo this. Yes, max. Okay. So yep, this is it. Okay, so yes, we're seeing woof. Whoa, look at that. That's what I'm talking about here. Okay. Speculation. Most likely that's speculation. I mean, I'll go through the order book later on today and see where all these orders came from, but I bet you a lot of this is speculation here, especially when it's one day. But surprisingly, what's actually surprising from the data is that a lot of it was block trades, which is a lot of it is going to be institutions. So are institutions really that bullish on the short term? That sounds like a retail thing to do. But then again, I can also see that a lot of quote unquote institutions that are getting involved in Bitcoin derivatives are probably like your hedge funds. Your hedge funds, everybody thinks hedge funds is smart money, but they're not. Hedge funds is just somewhat medium-sized dumb money. The real big smart money is like sovereign wealth nation funds. What else? Like, insurance companies, pension companies, banks, those are like your, big money managers. Okay. That's your smart money. Hedge funds are not. Hedge funds go bust, almost every year. So, they're just like dumb money, but it could be those block trades could just be a lot of hedge funds. Definitely possible. Let's see here. Oh, we're seeing some demand. We're seeing some volumes here too. 17,500 seems to be for next week. We're seeing some action here. Call side still the same. Where is all the action coming from? Let's look at 2 weeks later. Nothing much there. Well, we're seeing some calls here. So maybe some speculation at 23. Okay. And this is where a lot of action is happening. Yes, is end of month. So end of month, I think the reason why we're seeing a lot of participation in the end of month is probably because of the Fed meetings and the big central bank meetings. Yeah, so I think definitely that's a huge event. I mean, if the market doesn't, if the market just reacts unfavorably to whatever the Fed does, whatever the Fed may do, either go left or right, it doesn't matter, but it really depends on how the market reacts to that. So if there's a big risk off sentiment, it looks like people are looking around here. 16 to 14,000 is around where people are looking to hedge for the end of the month, it looks like. All right. So that's kind of the 1 month options positioning for a Bitcoin. I still think, even though there's all this call buying, I think it's temporary. And it actually often happens in these types of bear markets. A lot of institutions call for the bottom way too early. If you actually look at, other recessionary bear markets, they've lasted a lot longer. I mean, 2007, 2008, that was like, a 15, 16 month bear market. In the 1970s, again, it was the same thing, 12 to 15 months at a time. We would have these mini bull markets. The media says that the 70s is like 3 different bear markets. I actually consider the 70s one big bear market with a few mini bull markets in between. So, I don't think this is over. I think this is too soon. I think it's going to take a lot more time. And I think a lot of people are going to call the bottoms. And you know what? There might be some mini bull markets, but I see an emerging market credit crisis on the horizon with the dollar going up. We're already seeing in sovereign wealth bond markets. We're already seeing in emerging market currency markets. So, that is probably going to manifest itself next year. Also, I see commodity prices coming back sometime next year too. Will they come back to the same levels as this year? That I don't know. But I do feel like commodities will come back, maybe starting in March of next year. That will also probably drive inflation fears up as well too. There's a lot of unknowns out there, and to say that we're close to another bull market, I think is a little premature. Calling a bottom and then calling for the next bull market is two different things. When I say that we're looking for a bottom, what I'm really looking for is just a local bottom where we can play a bear market rally. Yes, these bear market rallies can turn into little mini bull markets, and I suspect that we're probably going to have a mini bull market maybe sometime in the end of this year. I think that mini bull market can last about 3 to 6 months, maybe up to a year, but then we'll continue. As commodity prices come back, emerging market debt crisis returns, and it becomes front and center, and as the dollar regains and keeps going up, I actually think that this could be something that lasts on and off for the next 4 to 6 years. So that's kind of my longer term outlook as well. But again, most important thing, risk management. Whatever happens, as long as we manage risk, the profits will follow. Okay. One last time. Again, the plan for Bitcoin, all right, is, okay, again, the plan for Bitcoin, I'm going to start buying when it gets to this line. Bitcoin to gold ratio, it touches this red line, I'm in for Bitcoin, okay? We closed 2 or 3 weeks below this line, I'm out. That's my stop, all right? That's my plan. Equities, okay? Same thing. Oh, the chart is on SPY. SPY, if we rally from here, we get to that 395, 400 zone, I'm going to start building put debit spreads 6 to 9 months out. Okay, or no, I'm sorry, 3 to 6 months out. If we get to 395 to 400, I'm going to scale in. All right, my biggest put purchases are going to be here around that 4,100, 4,200 in S&P 500. But I'm going to start scaling in at 395. All right, if we just shoot straight down, well, so be it. Around 342, that's when I'm going to start buying some more SPY shares to add to my long-term portfolio. If it dips under 340, I'm going to buy in the money calls 1 year out. Okay, that's my plan for equities. All right, oil. I'm going to leg into some put vertical debit spreads when it gets to 111. This is going to be small. My bigger put buys are going to happen when it's 119, 120. Okay, that is my plan for oil. Corn. I don't think it's coming back. I mean, the plan is to short at 720, so I'll buy some puts here, but I don't think it's ever going to come back here until next year. So let's just scrap corn. It is what it is. I mean, yeah, you manage risk. If you manage risk effectively, it means sometimes you miss out on some trades, but at least I avoid big drawdowns. And that's the most important thing. Again, risk management. So I don't think the grains are coming back. So let's scrap the corn trade plan. UVXY, I still have a position in UVXY again here, the 15-20 call spreads. If UVXY drops to like around 13s or so and VVIX is still low, I'll leg into some more 15-25 call spreads. Most likely, based on this current skew, 15, 25, long 15, short 25 Decembers. Okay, that's UVXY. FXI, if we see a little bit of a rally, we're seeing it's up 10 cents while we were talking. That's 0.3%. So if we see that it continues going up, I may leg into some more put spreads. Also, EEM, I still have that position. If I see that it goes up just a little bit, I may leg into some more March 39 puts as well too. Okay, I'm not seeing CEW, which is the Emerging Market Currency Fund. I'm not seeing that coming down. I don't see emerging market bonds going up either. I see that going down some more too. I think EEM will follow. So that's where my trades are at the moment, okay, and my current plan. Any other questions? Any questions, comments, rude remarks? Nothing? I see somebody typing. You like the Bitcoin gold ratio? Yeah, again, that's like something that I've been thinking about for months now. I don't always share like every idea that comes into my head. I know that a lot of you are looking to me for guidance. And so before I present anything, I like to check my facts, make sure, test things, ask around, ask other experts what their mindset is on this. Especially since I'm not a crypto expert myself, I just trade it. And so, I always like to make sure that everything I present is actually very, very sound. So I think it is very sound. I mean, after back testing it, after looking at the data, after looking at all those times where it touched that line, I'm pretty convinced that line is a thing. All right. So hopefully that helps you guys manage risk. All right, I'm going to use it as a risk management tool. So that's where I buy, and that's if we close 2 or 3 weeks under that red line, boom, that's my stop. So that I like to use those types of charts and those lines as risk management tools, and I think that's where it's really most effective. Charting, I think, has a place. All right, it does have a place. I think though the way charting is the most powerful is if we use it for risk management purposes. All right, but that's just me. Anything else? Oh, actually, you know what, guys? One thing before I leave. Okay, again, I forgot about this too. I told you guys about this a few weeks ago, or a couple weeks ago. This is growth versus value. Growth divided by value. We can see growth is making an uptrend here, okay? If we are to see another bear market rally, I think if you're going to go long on equities, go long on growth. The NASDAQ, I think, is going to outperform the Dow if we see a bear market rally here. So if you are compelled to go long and play that counter trend, I would go long on tech. Again, it's for a counter trend play. I'm not calling the bottom in the markets or anything like that. But if you're playing a bear market rally, and if you're compelled to go long on equities, this is saying that growth is being favored right now. all the buys, there's more in growth than in value. So just wanted to let you guys know. If some of you that are active traders or day traders, you may want to heed this chart. Okay. And maybe I go over more of this next tomorrow for tomorrow's high noon highlights. I'll focus on this a little bit more tomorrow. Okay. Any questions, comments, rude remarks? Again, going once, going twice. All right. Well, that concludes today's high noon highlights. Again, as always, if you're watching us on YouTube and Twitch, join us on Discord. We got great conversations happening here. I'll leave the Twitch stream up so that you can see my data and the charts that I'm looking at throughout the day. And I'll post the link on our Discord so that you can rewatch those videos. All right, guys. Stay safe, and I'll see you guys tomorrow.